Okay, well, hello everyone. A warm welcome to everyone who's tuning into this webinar today. I'm Deborah Lucas. I'm a professor of finance at MIT Sloan and the director of the MIT Golub Center for Finance and Policy. The Golub Center is dedicated to supporting research and educational initiatives that support better financial policy decisions by governments around the world. And I'm sure today's discussion will convince you of the urgency of that mission for improving people's lives in the context of the Indian financial system. We're very pleased to be co-hosting this event with the MIT South Asian Alumni Association, with Sangam, which is the MIT Indian Students Association, and with MIT India, or MISTI. Here with me is Ranu Bopana from the Alumni Association, and she's going to be helping me choose among the questions that you all in the audience will want to submit. The Q&A function on Zoom should be open to you, and you can enter your questions there. You can also vote others' entries up or down to help us in deciding on what questions to put forward. So now Ranu also would like to welcome you and say a few words about the Alumni Association. Ranu, let me turn it over to you.
Thank you, Professor Lucas. Hello, my name is Ranu Bopana. I'm class of '87 and president of the MIT South Asian Alumni Association. MITSA aims to connect the thousands of South Asian alumni from MIT with each other and with the Institute. If you know an alum who would like to be on our mailing list who is not, please encourage them to find us on Infinite Connection under Communities and add us to the list. And also please look for us on Facebook, Instagram, and LinkedIn. We're so pleased to be co-sponsoring this event. And now back to you, Professor Lucas.
Great, thank you very much. Well, it's now my pleasure to introduce to you Dr. Viral Acharya. Dr. Acharya is the C.V. Starr Professor of Economics in the Department of Finance at NYU Stern School of Business. He's also an academic advisor to the Federal Reserve Banks of New York and Philadelphia. He's an influential and prolific scholar, particularly on the topic of systemic risk, the role of governments in contributing to it, and to its proper regulation. He wears several other hats, but most relevant to his presentation today, Dr. Acharya served as Deputy Governor at the Reserve Bank of India from 2017 to the summer of 2019, where he was in charge of monetary policy, financial markets, financial stability, and research. He's here today to talk about his recent book, Quest for Restoring Financial Stability in India. So Viral, I'm going to call you by your first name because we're old friends. Welcome. And let me start off the conversation with a few questions about your basic thesis, which is fiscal dominance. What is fiscal dominance? And why do you provocatively say it's a theory of everything in India? And maybe you could also give our listeners a little background on the Indian financial system and how it got to be in the unfortunate situation where it is today.
My pleasure, Debbie. Firstly, thank you to you, Ranu, for organizing this. I'm very delighted that you were also able to rope in the Indian alumni for the event. Let's start with fiscal dominance, Debbie. In traditional macroeconomics literature, if you look at the work of Sargent and Wallace, fiscal dominance is a state of the macroeconomy in which government balance sheets have become so large, especially in terms of fiscal deficits, which is how much they are spending relative to the revenues they are able to generate, and therefore how much they are borrowing in the markets in order to finance these deficits. So when government balance sheets have become so large that the central bank, rather than focusing on the long-term objective of maintaining price stability and inflation at reasonable levels, instead becomes primarily preoccupied with helping the government roll over its debts. Okay, so when you have large debts, typically the situation that unfolds is that the governments first start borrowing more short-term, in order to not have to pay the term premium or the longer term interest rates to the markets. And as the debt maturity gets shorter and shorter initially, eventually the quantum of short-term debt that has to be rolled over could become so large that the central bank basically starts printing money and essentially buying the government debt either directly in the primary auctions or in the secondary markets, which we now call as quantitative easing or large-scale asset purchases. Now, in this traditional view of fiscal dominance, what happens is that once central bank gets distracted away from the long-run objective of inflation and is helping the government tide over its short-term debt rollover problems, the usual fallout is that inflation expectations in the markets get unanchored or unhinged from stable levels, because the central bank is not following a rule that when inflation takes off, they will actually focus on raising interest rates, curbing the credit growth, preventing the economy from getting overheated. Instead, it's going to keep allowing the government balance sheets to be rolled over so that the government doesn't have to undertake structural adjustments on its expenditures, on the size of its debt relative to GDP, etc. Now, if you take this lens and apply it to an emerging market, in my view, it's a very incomplete perspective on fiscal dominance, where the fiscal is dominating the central bank. And the reason is because in emerging markets, typically, such as in India, the central bank is not just the monetary authority. It's typically an all-purpose central bank. Very often is the debt manager for the government. So in the United States, debt management is with the United States Treasury Office. In contrast, in many emerging markets, debt management function is also with the central bank. In many countries, a part of the regulatory apparatus for the banking sector is not with the central bank. So for example, in the United States, we have the Federal Deposit Insurance Corporation, which is going to be the one that's dealing with failures of banks. In contrast, in emerging markets, this functions of supervision, resolution of banks are also actually saddled onto the central bank. What I'm trying to get to is that what Sargent and Wallace focused on as the fiscal dominance of the central bank from a monetary authority standpoint, in emerging markets, it takes an all-encompassing view. It starts affecting the debt placement functions of the central bank. It starts affecting bank regulatory and supervisory functions of the central bank. And in the end, at the cost of just a little bit of exaggeration, I call it a theory of everything in India, is because my experience was that as a central banker, when I was a deputy governor, it was hard to conduct literally any function of the central bank without having this continuous pressure from the fiscal authority, and given its stretched fiscal and debt situation, onto the autonomy of the central bank in its decision making. And let me just give two concrete examples to make this precise. So, in developed economies after the global financial crisis, it's become routine for the central banks to step into the bond markets and buy huge quantum of government debt. And, it's almost felt as though the monetary toolkit has expanded to quantitative easing and large-scale asset purchases. Emerging market central banks were doing this all the time in the decades prior to the global financial crisis. Because when the debt of the government is so large, when the fiscal deficits are so large, and when the institutional setup for the autonomy of the central bank is not that strong, it is routine for the central bank to aid the borrowing costs of the government by actually buying the government debt in either primary auctions or in the secondary markets through open market purchases. Second, we have discovered in the global financial crisis and thereafter in Western economies that you might have to not recognize bad loan losses of banks, so that governments don't have to recapitalize the banking sector in time. First, it happened in Japan in the 90s, then it has happened in Europe over the last decade. There is a fear that we might be on this path perhaps even in the United States in the post-pandemic phase, emerging markets have been doing this all the time. Whenever there is a bad leverage cycle and it goes bust, emerging market central banks routinely suspend norms for recognition of bad loans. They encourage creation of zombie firms. At any point of time, you actually don't know whether a bank is well capitalized as per Basel standards, or actually it is extremely undercapitalized by true economic standards. And that's because accounting rules, regulatory rules are being compromised all the time. So the picture I'm trying to convey is that in India, like in many emerging markets, the central bank is constantly compromised to meet the needs of the fiscal. In India, I can elaborate a bit more later on. The situation gets particularly perverse because of the state ownership of a big part of the banking system. And therefore, I think unless significant structural reforms take place, in India, fiscal dominance is a theory of everything as far as financial sector regulation goes.
Great. Well, there's so much to unpack there, but something I read in your book that I found particularly fascinating had to do with the effect on the Indian banking system. So for a long time, I had read that the Indian banking system was pretty dysfunctional. It's bad at allocating capital to the highest value users. It's very political. And also the number of non-performing loans, the default rate is just through the roof, and it has been for a long time. And you actually relate that back to your theory of fiscal dominance, which I just thought was fascinating. So I wonder if you could say a bit more about the kind of practical on the ground costs to the Indian economy in terms of misallocation of capital and other things.
Yes, Debbie. First and foremost, I would say that the primary cost of the fiscal dominance of the banking system and the regulators, such as the central bank, is the over indebtedness of the Indian government. To just put things in perspective, in the 1990s, there was something in India called as, which is still around, it's like a liquidity coverage ratio. It's called the statutory liquidity requirements, or the SLR as it's called in India. If I put 1 rupee of deposit into the Indian bank, 40 paisa of it, so 40% of the deposits had to be allocated to the Indian government borrowing. Now, this is a massive repression of the banking system. It was something that the central bank imposed on the banking system. Without imposing these levels of repression, the government debt borrowing programs would not be able to float through without the borrowing costs going through the roof. And who pays for it? Large firms can go to the corporate bond markets in India or abroad, but small, medium-sized firms, individuals who are reliant on the banking system for financing, either they would have to pay extremely high borrowing rates, or they would be rationed from the system altogether. So I would say the first and foremost, it is the mirror image, the over indebtedness of the government, and there being too little credit on the private economy. So the paradox of India, and this is my second point, is that on the one hand, as you mentioned, the Indian banking system is amongst the highest non-performing asset ratios in the G20 economies, while at the same time, private credit to GDP in India stands barely at 55%. Now, this is very peculiar. Typically, when you think of a system that has very high non-performing assets, you think about banks that are lending left, right, and center all over the economy. You think about social debt to GDP ratios, which are on the order of 150 or 200%, as in the case of China. But this is not the problem in India. So what is the problem? The problem is that because of the presence of state-owned banks, it's not just that the banking system is getting crowded out for making loans to the private sector. The banking system also gets routinely used to support fiscal stimulus. Fiscal stimulus, such as after the global financial crisis, was for specific sectors. It was for infrastructure, it was for ports, it was for the power sector. So there's a term in India called as phone banking, which is you get a phone call from someone in the government telling you where the loan should go. If it's not a phone call, it would be a board member on a public sector bank who has been told that a certain allocation of loans should go to a particular state. My version of this is that now in India, you often have what is called as phone central banking, which is that it's not that you make a phone call to the bank, you make a phone call to the central bank to change the rules of lending to a particular sector in order to support the government fiscal stimulus in that direction. Now, what has happened is that as a result of this pattern of tunneling or targeted lending as the government wants, invariably India since 80s, in 90s, in 2000s has gone through waves of boom and bust cycles in leverage because bankers are not allocating credit based on where it deserves to be made. It's based on where a central administration of the government is actually directing them to provide the credit. Now, because then credit discipline goes for a toss, invariably you end up with bad loans. Historically, the approach has been that every time one sector goes bad, you ease the rules to allow the banks to lend to another sector to get out of this problem without ever recognizing the bad loans of the previous sectors that have gone bad, without recapitalizing the banking sector to the right state. And through this repeated leveraging cycles, ultimately now we have reached what I would call as the crossroads. I think the bad loan situation of public sector banks, in my view, is now so large, and the government indebtedness, which was the first problem, is also so large that now the government can't recapitalize these banks adequately. And therefore, the only option left is to turn to the private markets and see if there are buyers for these institutions out there. So to cut a long story short, Indian credit allocation has been compromised so much, both through the banks and through the central bank, that you have low growth, low productivity. The government keeps borrowing more and more, focuses on what I call as subsidy or revenue expenditures rather than providing healthcare, education, and infrastructure, which are the public goods that government should be providing. And in the end, you have a steady erosion of the growth potential of the economy. Now, as I say this, things do seem to be finally turning around. Some reforms seem to be going in the right direction post-pandemic, but it remains to be seen if they are implemented with the same force as their intent has been conveyed so far.
Right. So in fact, that's exactly where I wanted to turn. So you've described just some pretty dire and daunting challenges. And I know that when you were at the bank, you were pushing very hard for some reforms. So I wanted to ask you about what you think should be done with the constraints that those proposals are something that you could imagine actually might be done given the political constraints on making changes.
Yes, I think one way of restating what I've been saying is that financial stability in India is tied at the hinges to the fiscal stability of the government. And because the governments are never moving on to a sustainable debt path or what might be considered as growth-friendly sustainable debt path, because you could sustain the debts but kill the growth of the economy through financial repression, and that's not what I have in mind. But because the governments are not moving on to a sustainable debt path, they keep eroding financial stability along the way. So I think I would say three things to me that are the most important is that first, the government needs to get out of doing fiscal stimulus by directing lending through the banking system. Every government that comes in India has its favorite lobby. Sometimes it's the incumbents in the large industries. Sometimes it's the small and medium-sized enterprises. Sometimes it's the housing markets. The favored constituency keeps changing each time a fiscal stimulus is undertaken. Now, it would be one thing if the government went directly and made transfers to that constituency through taxes to do this. But they don't use the fiscal policy because they're already overstretched. So they end up using the banking system through quasi-fiscal policy. So this needs to change. And for that, first and foremost, the government has to recognize that its purpose, its role is to provide the state functions of providing public goods, healthcare, infrastructure, and education, rather than actually getting into private business and helping them flourish through explicit and implicit guarantees. Second, the government needs to find ways of generating revenues to meet its debt, which are not too distortionary. What do I mean by this? In India, barring a few sectors such as healthcare and pharma, most sectors have a large presence of the Indian state. Financial sector being a prime example, banking, insurance, pension, these are all heavily controlled functions by the Indian government. And so if the Indian government was to embark on a path of disinvesting its presence in these sectors, it would find both productivity enhancement by transferring inefficient state-owned enterprises into the hands of private owners, but simultaneously it would be generating revenues that make its debt path a little bit more sustainable. Because if it can't do that, it has to keep increasing its debt burden, and then it leads to this fiscal dominance of the central bank and the financial sector. And the third that I think would be the most important is that the central bank has taken important strides towards being autonomous in its functioning. Adoption of flexible inflation targeting has been one of the big achievements, I would say, over the last decade. That kind of clarity of function is still lacking in the bank supervision and regulatory functions. These are still very easy to compromise with phone calls and constant pressure points for relaxing the rules away from the true spirit of the Basel standards. There's always enough national discretion in these rules that gets employed routinely to not recognize the true losses to be the right ones. Now, post-pandemic, there have been debt moratoria, there have been restructuring relief given to specific sectors. None of these have been recognized as losses in a timely manner. So what does this mean for bank health going down a couple of years? I think this is a big question mark. And anything that can be done to make this more rule-based rather than constantly being discretion-based would be a big step forward.
Yeah. So related to your last point, a nice question came in from Guru Murthy Kalyanaram, whose name I just slaughtered. He was noting that your experience and that of Raghu Rajan, who is the governor, is that your ability to implement some of these changes is limited by the fact that RBI's autonomy is not as clearly stipulated as it is for the Fed or for the ECB. So this whole issue of central bank independence and its necessity to be able to accomplish some of the things that you're suggesting, do you see the prospect that the tide could turn and more independence could be granted to the RBI, or what do you feel could be done along those lines?
Yes. So in the prelude chapter of the book, which is fiscal dominance, a theory of everything in India, I give a range of suggestions, but let me focus on two in particular. First, I think a part of the problem with the discretionary approach to supervision and regulation is that it all happens in the dark. The central bank is not transparent about why it is relaxing the rules for a specific sector in terms of capital requirements or lack of recognition of losses. There's no report that's put out explaining what are the benefits and the costs of doing this. There's no sunset clause that's typically attached to these discretionary forbearance for specific sectors. So it's not said that this is for the next 6 months or something. These are all just released. And then, it's like you've opened a genie out of the bottle, but then you can't put it back in. And these forbearances just become permanent reliefs for specific sectors that the regulator finds very hard to back off. So I would say transparency and democratic accountability of why you are adopting discretion at times. I'm not saying discretion should not be adopted. If you have a shock like the pandemic, you may have to accommodate the shock through some discretion. But the process for that is not very transparent in my view, and therefore it leads to abuse in the other direction. Even I felt India is always in a crisis. Every year is a crisis year because there's a national or a state election that's coming up somewhere. So you have to pump prime the growth of the economy to look good in the 6 months leading up to that. Now, if you don't have an accountability process for the central bank, it's easy for the government to turn to the central bank and say, oh, for 6 months, why don't you relax the rules for the small and medium-sized enterprises or for household loans and so on. Or for power sector or wherever there may be incumbents who are making large contributions to the government. The process can be so easily captured that it's not ideal. Second, let me come back to at the cost of belaboring and reiterating. I think that it's absolutely important to sever the link of the government from the financial sector. As long as the government owns the largest insurance company, it will not invest in corporate bonds as much as it can. It's going to keep investing in government bonds. As long as government owns the public sector banks over which it has dual control, so a part of the supervision and regulatory function resides with the central bank, but because the ownership is with the government, the central bank can never perform prompt corrective action. It can't sell off the bank away from the government into the private sector because the government has left it undercapitalized. So the dual control of public sector banks is legally enshrined in the laws of the country. And until, in my view, until that link is severed, India cannot really run the banking system and its regulation in a truly, truly independent manner. The rules have to, in the law, be made on a level playing field between the public sector banks and the private banks. In fact, to quote Dr. Y.V. Reddy, who was a former governor of the Reserve Bank of India, and has written this masterful forward to the book giving a history of India's political economy and fiscal dominance. He uses a term called a Hindu undivided family. For those of you who are not aware of it, Hindu undivided family is a tax structure that allows family members to make transfers amongst each other in order to reduce their tax burden. And he says that the Indian government, the central bank, and the public sector banks are like a Hindu undivided family where no one keeps anyone's accounts in order to keep hiding losses from one pocket to the other. And I think that situation has to really change for us to know whether the central bank is truly independent in its regulation of the banking system.
Great. Well, there's a million other questions. I want to remind, I'm starting to see a few questions in the question and answer. If you do have a question, be sure to type it in rather than raising your hand because we're not using the raised hand feature. And but before I turn to that, I have a few more questions of my own. So I want to talk about the Indian experience related to some other countries. So one thing that occurs to me is the comparison of China and the fact that it also has a very significant state-owned banking sector, yet it seems that China has found that it's good for the government to use some of those resources, at least to support private businesses. And, I kind of wonder if you've thought about, and China has grown because of it. So I wonder if you've thought about, what are the driving differences and the incentives for the Chinese government and the Indian government. India is a democracy after all. And I can't help thinking, but, it's kind of sad that in the world's largest democracy, the people aren't educated to understand the destructiveness of the current policies in terms of their economic well-being. So I have questions on that. And then just my last question will also be on the opposite end of it, which is for those of us living in the US and Europe, India's financial system problems seem rather far away, luckily, for us. But you've actually been working on financial stability issues globally for a long time. And how relevant do you think the concerns you're raising about fiscal dominance in India actually are relevant now to the developed world, particularly in light of the high spending in response to COVID-19 and the already burgeoning levels of government debt in the US and in many countries in Europe. So do you have any predictions about the path that some of these other economies might take and why they might be similar to India, or why we might be lucky and not go down the same path?
Yes, Debbie, a great set of questions. Let me first talk about India versus China. In fact, in the book, I try to explain that one way of understanding what's happening in India over the last decade is that it's regressing back to its socialist past of the 80s and the 90s, where you had a centralized government. Most of the enterprises were owned by the government. And in 90s we reached a tipping point when we had a balance of payments crisis, and then a wave of private sector reforms and disinvestments were undertaken by successive governments. Now the low hanging fruits of that have been I think collected by the economy, and a new set of reforms, improvement in the safety net, improvement in the financial sector regulation are now required. If we don't do that, the risk is that India migrates back to that 70s, 80s zone. Now, why is India different from China? One, as you said, not all decision making in India is centralized, as in China, where it's heavily centralized, so it's easier to coordinate decisions. But the second point I would make is that China has erred in the opposite direction of over investing, possibly in infrastructure. You go to towns like in Inner Mongolia, in Ardosh, etc. There's like ghost towns where you have 25% people living relative to capacity of the town. In India, the problem is the reverse. The government has focused excessively on giving subsidies of various types. And very often these subsidies don't even reach the last mile because there is so much wastage in the distribution of the subsidies along the way that they are not even fulfilling the purpose of giving something like a universal basic income to every household in India. So India has erred in the direction of doing what China does, but doing it in a way that's not creating infrastructure and investments. So as I said, credit to GDP in India in the private sector is very low. Investment ratio in India, private investments in India are actually right now very poor because infrastructure crowds in private investment, whereas just distributing subsidies and free goodies to the population doesn't necessarily have that feature. So to me, that's a big difference. Now, this can also be viewed as a positive, though, which is that India, by not being so centralized as China, may feel a greater pressure to adopt market-based reforms over time than China has. And if it plays its cards right, I think these reforms can possibly put India on a more sustainable growth path. It remains to be seen whether China can come out of the huge debt it has in the system as a whole in a very decisive manner. Turning focus to United States and the Western economies, to me, what has happened in Japan in the 90s and Europe in the last decade, and I've been doing a lot of research on Europe, on its zombie lending, lack of productivity, lack of any inflationary impulses in spite of very accommodative monetary policy. Many of these features actually look like emerging markets to me already. So I see the world more on a continuum rather than it being advanced economies versus emerging markets. And I think the revelation to me has been that financial crises have a tendency to turn the policies in either of two ways. Either you could become like United States, where you adopted stress tests, you recapitalized the banking system in a very decisive manner, and even if imperfectly, you strengthened many of the loose ends in the banking sector. Or you could adopt a Japan or European style approach where you basically keep going light on the banking sector, hoping somehow that growth will turn around and allow you to wipe out the non-performing losses at the banks. Invariably, the second strategy, I'm yet to find a single counter example where a strategy of hiding the losses of banks has worked out to the long run benefit of the economy. And I think that is what emerging market crisis should have already taught us. Japan should have already taught us. And yet somehow regulators and governments find ways of claiming this time is different, and adopting the same policies all over again. Now, so where do I see things headed? I'm a bit concerned that Europe is taking on massive government debts, encouraging zombie lending all over again. It doesn't have as much of a creative destruction of firms because bankruptcy system is not as vibrant in Europe as it is in the United States. And I fear that it might be headed down a path of even lower productivity than where it has. Even if all these measures could have been justified in the post-pandemic phase, it's hard to restart optimal credit allocation in the economy if you have allowed it to go wrong for a while. The concern in United States that I see is probably more in the other direction, where rather than ending up in low productivity, low growth, it could be that the size of the stimulus ends up being too large. The government debt may be too large. The Federal Reserve has also hinted that it's going to tolerate slightly higher inflation. Rather than keeping inflation at 2%, it will target average inflation. And because we have undershot, market has interpreted that to mean that the Fed will allow inflation to run off beyond the 2% target for a while. What does that mean for the term structure of interest rates? I think we are already seeing a lot of pressure at the long end of the United States rising. Inflation expectations are rising, while simultaneously everything looks frothy in the equity markets, in the corporate bond markets. The spreads at which the C-rated firms in the United States are borrowing right now is just staggering, because everyone says that if things go bad, we have a put from the central bank that they will somehow come out and stabilize everything. This scenario doesn't look great to me. A fiscal stance which is very expansionary, a corporate sector which is heavily over leveraged, especially in the weak credit space, and households which have so much savings that they are punting left, right, and center in equity markets. This looks to me more like an emerging market balance sheet of the economy. The key question, I think, in United States is going to be the Fed's credibility on inflation. I think if the markets remain convinced that the Fed will dial back at the right time, I think that will raise interest rates in the short run. That will put a disciplining pressure on the US government to fix the fiscal house, so to speak. But if not, I think we could have some turbulence as we saw with taper tantrum and things like that over the last decade. So I think different countries are likely to follow slightly different paths based on the health of their banking sectors and the credibility of the central banks on inflation.
Right. Well, I'm going to turn to a number of questions that have been coming in. There's a lot of good questions. I'm going to just start with one that occurred to me earlier. I don't know if you've done this, but Jit Tandon writes that this is a systematic self-imposed drag on the Indian GDP. And have you thought about quantifying the percentage impact on the growth of India's GDP? Have you kind of estimated exactly what the cost is to the country?
Yeah, these potential output calculations are very hazardous. The econometric methods, which are state of the art, are not very structural. They are fairly reduced form, and they assume that what you have observed in the past is a reflection of what you are going to see going forward. Some of them are Bayesian in the sense that they recognize that certain parameters may be unknown, and as new data comes in, you revise your priors. Now, if you did these kinds of potential output calculations, last 3 years, India's growth rate has been quite weak, even pre-pandemic. It was steadily coming down from 8%, in fact, to 4% levels. If you therefore took this kind of Bayesian or learning approach, your potential output estimates would not be that great for India going forward. The flip side is that in emerging markets, very often this can result in a wave of structural reforms. And there's no shortage of the kind of reforms on land, labor, agriculture, infrastructure, financing, etc., that India requires. So of course, if those structural reforms take place, then the potential output can turn around again. There's a last chapter in the book called "The Crowding Out Effects of Government Financing." Therein, I don't link the cost of the self-imposed expansive government budgets and borrowing programs directly onto growth. But I do provide quantitative estimates there of what impact that has on the corporate cost of borrowing. I provide estimates there on lack of transmission of monetary policy to the real economy, explaining how in times of high government financing requirements, the monetary policy simply passes through to the government yield curve, but not at all to the private sector of the economy. Those would then need to be translated through growth multipliers from the private sector into the overall GDP growth.
Great. So there's a number of questions that people actually have about the management of the non-performing assets. So let me try to kind of put them together. So, there's been a lot of proposals that somehow they're more manageable if you can create a secondary market or a good bank, bad bank kind of structure in order to deal with them. And so I guess one set of questions regards, is that feasible in Europe, say following a European model, or what do you see as the impediments to doing that? Have there been efforts to try to do that in India, and do you think it would help?
So recently, the government has announced a proposal to set up a bad bank. There isn't yet a blueprint that's been provided of how it's going to be set up. The public sector banks want the transfer of non-performing assets from their balance sheet to the bad bank at the full present value. They don't want to take any haircuts when this happens. If that is done, I don't think it serves any purpose. You are just moving the problem from one balance sheet to the other, and therefore from one pocket of the government to the other pocket. I think the idea would be that you bring in a set of international and domestic experts who can value distressed assets, resolve them in the right way in the bankruptcy system. But to do that, they have to make some money. Otherwise, they are not going to come in and just do this for free, which means that some price discovery has to happen, and they have to also make some potential returns from turning these assets around. And so, in my view, the primary issue is going to be the price at which the assets get transferred from the banking system to this bad bank. And the best way to do it is to set up some kind of a market for doing that. Korea did it very successfully in 1998 after the Southeast Asian crisis. It actually set up a utility which provided standardized transparency on the bad loans. And the asset manager, which was government owned to start with, essentially created a market for discovery in bidding of prices. Right now, whenever bad loans are transferred by Indian banks, it all happens through sealed auctions. No one knows the ultimate prices at which these auctions are settled. Or even if the bids are not accepted, no one knows which bids have been rejected. And so there is no information symmetry or clarity about this market at all. And I've been pushing very hard for an online transparent loan sales platform in order to get some confidence about the prices at which loans should be marked in India.
Right. So there's a few more questions related to this broad topic, so I'm just going to pursue it a little bit further. Ramesh Vaidya asks about the power sector and infrastructure, and asks about the potential role of development banks in or infrastructure banks in helping, I guess, both to fund the needed investments and to help work out the bad loans. So I don't know if you want to, I know you've talked about state banks being intrinsically conflicted. I wonder if you have a view on the infrastructure banks or the development banks and whether they have a role, or whether, and other people kind of ask, should you just go to allowing in more private sector banks, as a way of getting better investment outcomes? I'm combining a bunch of questions, but
Yes.
I think they all go together.
See, it all comes down to this issue of fiscal dominance, in my view, in the end, and therefore I've called it a theory of everything. People always ask me, what would it take to kickstart a corporate bond market in India? What would it take to kickstart infrastructure finance in India? In my view, the number one requirement is that the government borrowing program has to be smaller. Because unless and until that happens, you will not have insurance corporations, banks funding any of these other loans. They will only be funding the government. It's just a quantity constraint. What the government borrows as a whole in India is larger than the net private savings in India. So where is anyone else supposed to borrow from? It just, there's an accounting identity that can only be met by borrowing from abroad. Now, without good property rights, without good transparency on corporate and infrastructure company balance sheets, foreign investors are not going to pour in money into these projects. So I would say at a very high level, that's the first and foremost requirement. Now, what needs to happen at a more micro level is that even if banks or development finance institutions are the originators of these assets, ultimately they need to be able to transfer these assets through securitization or bond markets onto longer term liability holders. So, insurance companies are the ones who should ultimately bear the insurance infrastructure risk, because it's a very long term risk. And therefore, it should be met with long term liabilities rather than it being on balance sheets of banks. And that's where lies the failure right now. There isn't a thriving market for these kinds of asset transfers or securitization. Insurance companies are too busy buying government bonds at very attractive term premia rather than taking on duration risk, which is in the private sector or of the infrastructure investment types. There are also other problems which are beyond financial. The government genuinely has lacked capacity in helping infrastructure projects get off the ground with predictable policies. A lot of infrastructure investments that went bad in India during 2009 to 2012, a big part of the problem was policy uncertainty and flip-flops. Not being able to connect a gas pipeline to a power project. Now if the government doesn't give you clearance for that, that project is going to be delayed by 3 to 5 years. If government doesn't clear land acquisition for a new airport that is supposed to be set up, the private operators cannot really make money because the projects don't even get off the ground. So there are also state capacity issues which are linked to the success of infrastructure. And I think, different factors have to come in together for this to thrive. And this is where China overall does a better job and errs in the opposite direction, as I said, than India does, where India sees underinvestment. China, because of its coordinated model, if anything, sees overinvestment.
Right. Well, actually, a sector we haven't talked about, and this is motivated by a nice question from Shivang Tayal, which is that there's been the recent farm protests in India. And how do you think about possible reforms in the agricultural sector, say in terms of agricultural lending and growing supply chain? And do you think that some of these reforms could be helpful in terms of the whole situation, possibly making the subsidies less important and making the financial system more functional and increasing farmer incomes?
Yeah, so most of the agri debt problems have ultimately ended up on the government balance sheet. In fact, there was a very nice paper by Sean Cole at Harvard and now at or MIT and now at Harvard, which shows that basically the agricultural lending cycle in India is not coincident with anything other than the political cycle in India. So every time there's a state election, farm loans are written off, which means that banks will be paid in full by the government. And so all the agri problems of bad loans end up with the government. As you pointed out, there are also agri subsidies, which are in the form of what are called as minimum support prices. So rice and wheat, which are the two largest produces in India, they get procured in India by the government and warehoused through the Food Corporation of India And the Food Corporation of India runs a huge balance sheet in order to fund all this warehousing, procurement. The procurement generally happens at above market prices. And the misfortune of this procurement process is that the entire gap between the minimum support prices offered by the government and the retail prices in the market is captured by the large wholesalers, who are actually the large farmers in the country. So one of the reasons why there is protests in India is partly because these incumbents, the large farmers who make a lot of money off the government through the minimum support prices, will lose that subsidy that's been accruing to them. Second reason why there are protests is because farmers have not been given clarity on if the market is allowed to function normally, which is in the form of a free market for agri prices rather than through the minimum support prices. Will there be some processes put in place to prevent a capture of the pricing process by the large firms in the economy? So I think what has happened is, even though the farming bill and the reforms are in the right direction, actually all the agri-economists mostly are in support of these reforms. The central bank has also been pushing for these reforms for a while. And yet there is a lack of trust between the end farmer and the government on this issue. And I think that trust deficit probably comes from the fact that farmers feel that if they are not going to have the support of the government in the pricing markets, will the government ensure that they are not being fleeced by the large agri companies in the process? So the government needs to do something to resolve this trust deficit. I don't know what's the right way of doing it, but at least on the face of it, the reforms look to be in the right direction.
Great. So we're running out of time. One question that also got some votes, I think it's a hard question, but I'm going to throw it to you anyway, which is the question of what citizens can do to keep the government and the public sector accountable when regulators and the government itself fails to do so. So do you have a sense of what could happen in India or elsewhere? And I think this is from Kopizo Tibe, who also notes that these very same problems are very prevalent in Africa, where he or she is from.
Yeah. Ultimately, I think it's the right question. I think it is about the governance of the state. It is about, how can we hold them accountable in a better manner? I would say first and foremost that requires good accounting practices, acknowledging what is being spent, how it is being spent, what are the returns on that. We don't do as much research on public finance as I think academics should perhaps be doing. With ever expanding scope of and scale of the governments, I think a lot more academic research needs to be devoted, I think, to studying public finance. Of course, Debbie is a pioneer in this, but I think we should have a lot more people doing this. In fact, the tragedy of a lot of research in finance has been that whenever we do corporate finance, we exclude utilities and regulated financial firms. And very often, these are the most interesting entities as far as public finance is concerned. It's the financial sector and the utilities who are the most important connections of the government to corporate finance in the economy. So that's one. Second, I would say that there needs to be some public discourse, and I think it is emerging about the right size of the government. I think we seem to be hurtling in a direction since the global financial crisis where the government balance sheets keep getting larger and larger and larger with every shock that has materialized. The central banks are facilitating this growth of the government balance sheets by engaging in large quantitative easing or asset purchase programs. It's a valid question as to when the balance sheets of developed economies will start turning towards looking like those of emerging markets. When will the state become the most influential player in any decision that gets taken in the economy relative to the private sector? And whether ultimately this has detrimental effects on growth. So very often I find that the discussion about the size of government borrowing programs is all about what's the cost of government borrowing relative to the historically observed growth rates. but it should really be about what the present size and scale of the government balance sheet implies for future growth rates of the economy. And that question is not getting as much attention in my view. The fact that the growth of the economy is a consequence of the size of the government balance sheet rather than something that should be decided taking the growth of the economy as given going forward. And lastly, I would say, to just end on a very practical note, I find that a lot of accountability of the government goes for a toss because increasingly we are voting and casting our votes all over the world on issues which have nothing to do with economics or the welfare of the households. We are voting on a lot of social issues. We are voting on a lot of different criteria that we are looking for. Of course, the hope is that over a period of time, underperforming governments will get voted out, and the ones that are performing might have a shot at getting re-elected. But I think as long as in a democracy, as long as the change of the governments which are underperforming happens right, over a period of time, you should see the right policies. And therefore, some of the recent outcomes where perhaps populist governments are increasingly being challenged on their economic performance, in their performance on dealing with healthcare infrastructure and their ability to deal with the pandemic, etc. I think ultimately we have to hold the state accountable for providing healthcare, education, infrastructure, and through that contributing to the economy. If they are not performing these core functions well, I think democracies can thrive only if they look for different solutions from governments and the organization of the state.
Good. Well, it's been hard to prod you into saying anything that's optimistic, and I'm actually sympathetic with your views. And so I also am sometimes terribly pessimistic, but I thought I would throw in that I think it's actually people like you who go into public service in places in the developing world and in the developed world too, who are thoughtful about these issues. And in fact, MIT and the students we train and the community that we create that really cares about getting the world to be a better place and getting policy right is, something that we can only hope will eventually move things in the right direction. I guess I wanted to throw in just a more optimistic word at the end. We have very little time, but I thought I'd also end with one more very fun question that came in, which is a little bit to the side, but interesting, and I know on the minds of many people. Someone wanted to know your opinion on cryptocurrencies and whether you think that's going to be a sustainable structure. As you know, some people are jumping to cryptocurrencies because they are so concerned that the traditional system of finance does have so many instabilities that threaten it. And so perhaps this is an alternative that's attractive to some people. So I don't know if you have any thoughts on that as a final word or anything else you want to conclude with.
Sure, Debbie. On crypto, what I worry about crypto is that it looks to me that we didn't like cash because it creates opacity. And while cash is anonymous and therefore attractive to a lot of private transaction making, it has the misfortune that ultimately it's not accountable. And so, it could be used for illicit purposes. Then we have moved to digital. But then, of course, now we have started providing anonymity within digital because, a lot of players do not want their transactions to be recorded anywhere. So I like to separate crypto into two components. Therefore, there is a financial infrastructure component of crypto, which I think through blockchain, etc., seems very promising. It could facilitate easy transaction making. It could reduce transactions costs. It could bring down large foreign exchange commissions, for example, that banks charge to someone like me who transfers dollars on a regular basis to Indian rupees to my parents. I pay a 2.5% to 3% charge for nothing practically. It could also allow small and medium-sized enterprises to create transaction registries much more easily because they'll be doing digital transactions rather than cash transactions. So that's the whole financial architecture side of it. And I pretty much welcome the technological innovation taking place there. But I do worry about the fact that ultimately crypto might be a big haven for doing illicit transactions outside the purview of the governments. Now, on the one hand, we have imposed heavy anti-money laundering rules, etc., on the banking system. They incur huge costs. There are still abuses around these rules, but they do incur substantial costs in knowing your customers and getting all the document verifications for transactions that are taking place. I worry that a little bit of crypto is just a regulatory arbitrage around all these anti-money laundering rules. To me, it is not a coincidence that the tightening of the anti-money laundering rules was very much followed at the same time with a rise in all this crypto. So I think we'll have to embrace the bright side of the financial innovation over a period of time, but I have no doubt that crypto, if it flourishes, will ultimately come under the regulatory purview and be subject to anti-money laundering rules and the like. Now, whether at that point it will still remain attractive as a way of doing payments and settlements, as a way of investing in it, etc. And of course, there's some speculative aspect to it, which is just like any other market. Let me just end by saying, Debbie, that actually, in a way, even though I'm critical of the trends we are seeing, partly, the reason why I talk about these things is because I have hope that if you have the right discussions, you can nudge the system in the right direction. Because I think if I was entirely pessimistic about it or cynical about it, then I wouldn't write the book. I wouldn't go on public speaking, hoping for change. And I think the good side is that actually, if you look at the last union budget of the Indian government, I think for the first time, there is an explicit embracing of privatization as a future direction of the government. I think that's new news, I would say, over the last 20 years. Since the 1998-2003 phase, when divestments happened in a big way, privatization basically took a standstill from all the successive Indian governments. And I think there is hope now that it's a shift in the right direction. I think my sense is dialogue of this type does sometimes send the right sound bites. They may not get picked up right away, but eventually good ideas always find their way of percolating up to the right places.
Great. Well, thank you very much, Viral. I know that everyone is applauding for you, although we can't hear it. And Ranu, thank you for also helping to organize this. And this will be the end of the webinar. And everyone have a good day. Thank you very much.
Thank you so much, Debbie and Ranu, and all the best to everyone who was in the audience.